What's up, tax fam? For many small business owners, the end of each financial quarter signals added stress and hefty tax bills. But thankfully, there are plenty simple and legitimate ways to reduce your small business tax bill while still meeting all your tax obligations. So in today's video, I'm going to talk about a few ways that could make quite a major difference in tax time. I'll jump straight into the first one. I'm sure you're all sick of me repeating myself about this one, but there are two words that are really super important. Business structure. If you choose the wrong structure for your business, it could cost you loads in taxes down the line. Companies, trusts, and sole traders all have different types of tax rates. So depending on which structure the business is operating from, the tax is different. For example, if you're operating your business under a sole trader, your individual tax rate can be anywhere between 19 cents in the dollar to 45% in the dollar. The company structure, on the other hand, is taxed at the flat tax rate or 25% for small businesses. So obviously, you're being taxed as an individual at 45%, the most tax effective structure will be to restructure your business as a sole trader to a company. I mean, there's a whole 20% difference in tax rates. It's literally a no-brainer. So assessing your business structure is a good first step to reducing that tax bill. Another underrated aspect of your business to assess from a tax perspective is whether you operate on a cash basis or accruals basis. If your business is operating on a cash basis, you're recording income that flows into your bank account when it's received and expenses when they're paid out of your bank account. And with accruals, you're recording income expenses in the same way, but the timing is kind of different. So essentially, you're recording income before you received it and expenses that you've not yet paid for, and you're recording those expenses as income. For example, once you've completed a service or sold a product, you'll issue an invoice to your customer and record that transaction even though the invoice is yet to be settled. And if you made a purchase on a credit, you record that expense even though you have not yet paid for it, and that's accruals. From a tax perspective, with the cash basis accounting system, you will need to account for tax in the reporting period in which you receive the payment for the service or the sale, and the same applies to your expense. And with the accruals accounting method, your income becomes accessible for tax even if you haven't even actually received the income. So this could really impact your cash flow if you don't plan properly. Having said that, the most common method for lodging income tax returns is actually the accruals method. This is because an entity is able to deduct expenses that have been incurred but not yet paid, and they can also write off bad debts for income that has not actually been received but issued. Anyway, it's pretty important to understand what accounting basis your business operates under in order to figure out at which point in time the income will be accessible for tax purposes and the expenses are accessible for deductions. The third way you can pay less tax is to claim your tax deductions. We all know you've got to spend money to make money, and if you spend it to produce accessible income, then your business will usually be entitled to a tax deduction. Many businesses trip up by inflating the deductions or claiming for something they shouldn't have, but a surprising number also miss out on deductions they could have claimed, and in reality, there are legitimate deductions that almost every business can take advantage of. The golden rule is that you need to show you are actually out of pocket and that the expense has been incurred to run your business. If the expense is a mixture of business and personal use, you can claim the portion that is used for your business, but not the private use portion. And then you must have proof of all these expenses, so record keeping is essential as well. Make sure to check out this short video for a common list of tax deductions you can claim each year. There are a few expenses you can't claim though, such as your entertainment expenses, penalties and fines, and expenses relating to income that is not accessible, such as money you earn running a hobby. Timing is also super important if you want to make the most of your tax deductions. For example, if you know your business will be spending on equipment or any other business assets in a few months' time, but it will fall in the next financial year, you'll lose out on those tax deductions in the current financial year if you don't spend now. So it might be a good idea that you bring forward those expenses and spend it now in this current financial year so you get that tax claim. Tax tip number 5 is to make concessional super contributions. Concessional super contributions are taxed at a rate of 15%, which is likely to be lower than your income tax rate. You can claim a deduction on your contributions, and the general concessional superannuation cap is $27,500 for all individuals regardless of your age so far, and it's up to the current date of 2022. That's why it's a good idea to make the contributions up to that limit before 30 June. And lastly, claim asset depreciations. So if you haven't heard of the instant asset write-off, you're kind of missing out. So make sure to watch my video on this topic. But in a nutshell, the instant asset write-off scheme allows small business owners to maximize their deductions by claiming the depreciation for certain eligible assets as an immediate deduction instead of spreading it over 5 years or a few years. There's usually a threshold amount for this, which the ATO changes each year, so make sure to keep up to date with that or speak to your accountant. The Aussie government also introduced another small business depreciation incentive as part of the 2022 budget. Temporary full expensing, which allows small business owners to deduct the full amount of any eligible depreciation asset first used or installed after the 6th of October 2020. In other words, there is no threshold until 30 June 2023. This means you can claim an immediate deduction for any asset regardless of how much it costs. The only exception to that rule is motor vehicles. This is capped at around $60,000 for 2022 financial year. So these are the few of my tax tips for you. Hopefully they can help you cut down your tax bill and keep you out of jail. But remember, it's always a good idea to seek professional advice from a tax specialist or accountant to make sure you're operating as tax efficiently as possible and also meeting all your tax obligations. If you're unsure about whether any of those above tips are applicable to you and your business, feel free to leave a comment below. But otherwise, I'll see you next time.